Investors and athletes have something in common. The ones who take bigger risks tend to win bigger rewards. In recent years, millions of Americans who were once just savers have opened mutual fund accounts and become investors as well. This chart shows why. Stock and bond mutual funds have provided higher returns than CDs and money market funds over the long term, but they also involve more risk.
The fund will fluctuate, the principal will go up and down, and they're going to have to live with that if they want that better rate of return.
If you've been a saver with a passbook account or CD, you're used to having up to $100,000 in your account insured by the government. But when you invest in mutual funds, no matter where you buy them, they offer no guarantee against loss of principal, either from FDIC or SIPC insurance.
The price of the shares of this fund can fluctuate up and down.
On the other hand, mutual funds are subject to strict regulation by U.S. and state governments to protect investors against fraud and abuse.
All mutual funds, whether they're sold by banks or securities firms or insurance brokers or financial planners, all of them must register with the Securities and Exchange Commission. Second, all funds, no matter by whom they're sold, must give people prospectuses which describe the fund, its costs, its risks. So there are a lot of protections.
Investors who want to carry home bigger rewards must weigh those investment returns against the risks. Malin Jennings reporting. If you want to invest in mutual funds, join the crowd. Over 38 million Americans are fund investors. For years, they bought their shares from brokers, insurance agents, financial planners, and the funds themselves. Now, increasingly, they are also buying them from banks, which can be confusing because unlike other products banks sell, mutual funds are not insured.
It's extremely important that the bank customer understand a few things about mutual funds if they buy them through the bank. Number one, just because they pay for that mutual fund and invest in that mutual fund at the bank doesn't mean it's FDIC insured. It's not.
There are important differences between mutual funds and bank deposits. Over time, stock and bond mutual funds have generally provided better long-term investment results than CDs or bank accounts, and they are subject to strict regulation by the government. On the other hand, mutual funds involve investment risk, which means you may lose money if you have to sell when prices are down.
This purchase is not a guaranteed investment of the bank.
And no matter where you buy them, mutual funds offer no guarantee against loss of principal, either from FDIC or SIPC insurance.
The fund is a securities product that has risk and reward. It is not like a bank deposit, which is federally guaranteed and federally insured up to $100,000.
In other words, mutual fund investments involve both reward and risk, no matter where they're purchased. Malin Jennings reporting.
The key thing to understand if you buy a fund from a stockbroker or a financial planner or an insurance agent or a bank, it is a pool of securities. You're buying an interest in a pool of securities that can go up and down in value, that are not guaranteed, that are not federally insured.
This product, a tax-free bond fund, is not guaranteed by our bank. Therefore, it's not FDIC insured. And I think it's important that you recognize that. Sales charge for you to buy the shares at all. If you were to redeem these shares within the first 5 years, there'd be a 2% redemption fee on those shares. If you hold it,
That's why I didn't get on the highway today.
Yeah. Go for it at 3/4.
Don't have the full page.
How about before me?
Somebody else need to pick up. We're gonna pick it up for 3,500.
Mighty Dak Tech?
Thanks. Thanks.
Hey, thank you.
Thanks. Thank you.
And the Outlook, it's pretty scarce paper, so we were thinking
I'd be glad
that
to do that.
you might be able to buy it close to the regular AA scale. So in terms of having something with a little scarcity value and that's reasonably liquid, we were thinking we might do that, and then when it appreciates, swap into something else.
Portfolio.
Yeah. I mean, he's been there for not even a year, or just over a year, and now he's like,
Gosh.
Hi, it's John. Can I help? Oh. Well, hello. Fine. Okay. Yeah.
Place called Red.
Or, you know, maybe I might put some stuff back tomorrow. Oh, how far?
And also just coming down the curve to the 5-year note. Okay. And are they reasonably liquid? I got a feeling over time that these other guys are going to do pretty well. You know, I mean, as far as liquidity goes, they're going to do a lot better.
Right, it's a required $1,000 minimum in your account, Ms.
Is check number 109? Okay, that's what I'm showing. Okay, and you want me to fax that?
just want the net asset value as of the agreement.
Okay.
This is Sheila. How can I help?
Uh-huh.
Okay.
You're welcome. When I send you the application and you mail it back, it will take about 5 business days for that to be set up. Basically what we do is we send dummy transactions back and forth to be sure that the instructions are accurate. Well, I am showing wiring instructions to Provident National, but that's...
Mutual funds are something where you buy today, you know, hopefully at a lower price and sell later, you know, at some point down the road, maybe 5 or 10 years at a much higher price. And that's basically what the objective of this fund is. So, you know, if you're investing for your retirement, or if you have, you know, education needs or something, you know, long-term objectives like that, this is a fund that I think would probably do pretty well for you. You know, I think you'd agree it's pretty impossible to say where a growth fund is going to go. It's going to be tied into the market, and anybody that thinks they know where the market's going to go over the next few years is probably being a little bit unrealistic.